Hello, this is Jordan, and this is your precious metals market update. This is being recorded on the evening of Thursday, November 19th, 2015. And start off, let's just reiterate what we see here in the big picture for gold. This is the monthly chart. Again, major failure last month when it tested 1180 and closed well below it. 1180, as we can see, that was a key level over the last couple years. And over the last 3 months, that recent rally, gold formed a bear flag. It's broken down from that formation. We've seen a steep drop this month down to a low of 1062 a day or so ago, has rallied up to 1081, or 1081, that's where it closed. It did rally up to, I believe, 1086. But anyway, these little rallies here, over a couple days or whatnot, they don't change the major trend here, which is bearish, until we at least see a test of $970 an ounce. That's the first major support, and then the second one is $890 an ounce, as you can see there on the chart. So keep that in mind. We can certainly rally a bit more in the short term, but the big picture remains very bearish until we break lower and get close to testing that 970 support area. And I want to talk about the COT for gold. And we got the report on Monday, and usually we get the reports on Friday. So getting the report on Monday, it's already old. We're talking about it now. So this data is as of 8 trading days ago. Since then, the gold price is down about $5 an ounce. And so the net position then, let me go back to that. The fact that the gold price hasn't changed a whole lot since the last report, I'm not expecting that much of a change in this next report. Remember, it's as of Tuesday of this week. Now, the net position as a percentage of open interest, the net speculative position, 16.5%. It's rounded up to 17% in the chart, and you break that down, the gross short position is 33%, the gross long position is 49%. I've had some people ask me about the COT. I've seen some people say, it's looking bullish. Of course, you can interpret it however you want. My interpretation is this is not bullish yet. It's not going to be bullish until we see the net position come down close to zero. The low several months ago, I think it made a low around 3%. It's at 17% as of the last reading. And if you look at the gross long position, I've talked about this before, it's at 49%, and it's been relatively stable the last couple years, which is a surprise. You would expect longs in the market to be selling. And they were selling in 2012, but since 2014, they haven't really been selling that much. It's been going in a range. And so the 15-year low is around 39%. That's a 2007 low, and we're at 49% right now with the gross long. So what we really want to see for a bullish situation, we want to see the gross longs come down and break below 40%. We want to see the gross shorts get to 46%. That was the recent high several months ago. So certainly the COT right now looks better than it did 2-3 weeks ago, but it's not giving any kind of a buy signal yet, in my opinion. Now, whenever this bear market ends, I think what we could see is something like this. You see the gross short position, maybe it exceeds that 46%, maybe it gets up to 50%, 55%. The gross long position, we're going to have to see the longs capitulate. That's where the additional selling pressure is going to come from. It's at 49%, needs to go below 40%. If you have a 50% short position, 30% long position, then the net speculative position would be minus 20%, meaning that the speculators would be somewhat heavily net short. They've been net long gold for the entire bull market for the past 15 years. So, and the reason why that would be bullish is because you have a big short position in the market coupled with a low long position. And so that can give you a springboard to a big rebound. You get the short covering, but the rebound could be sustained because all the longs are already sold out and there's not that many left to sell on the rebound. And so the longs, I mean, they instead of because longs have already sold, then there's room for people to buy, and so that I think is what I'm looking for from the COT to. I mean, that's what I think to give you a picture of what it might look like when we see gold get down to those targets of 970 or 890. That's what the COT, in my opinion, could look like when this bear market is going to end. We're not close to that yet right now. And let's focus on the short term here. This is a daily candle chart. Now, it's a tricky situation for gold because it's very vulnerable to further declines because it's broke below 1080, but at the same time, it's very oversold in the short-term sense. So it's a tricky situation. Gold is at 1085 as I record this. Earlier today, traded up to resistance at 1086. I've drawn the support line there. A daily close above 1086, which would be yesterday's high, and I think gold in that case is likely to test 1100. I think the maximum short-term upside from here is probably to 1110, and of course it's possible it could go up a little bit more. I mean, the 20-day moving average is at 1111, 50-day moving average is at 1130, but that's coming down. But really focusing on 1100 here, that's the key resistance target in my opinion. And the key support level is at 1040. So if gold in the next trading day or two fails to clear 1090 or 1087, if it fails in the next couple days, then it could resume its decline and drop to 1040, the next key support, and then perhaps from 1040, that's where we could see a bigger bounce. Maybe it bounces back up to 1080. So again, very tricky situation here in the short term, but I aside from gold popping another $20 or so from here, I don't see that much upside. Let's look at the miners. Here we have GDXJ on the top, we have GDX on the bottom, and you can see that 2 days ago, yesterday I should say, the miners bounced from their support, their lows of this bear market. So there's some good support there for GDXJ, just above 18, and for GDX at 13. The resistance we want to focus on, there's a confluence of resistance right around the 50-day moving average. Now looking at GDX, it closed just below 14, but let's call it 14. 50-day is at 1464. There's a lot of lateral resistance in that area, 1440, 1460. The miners did already fill the open gap from a couple weeks ago. I should mention that. And if you would draw a 38% retracement from the October high down to the low yesterday, the 38% retracement would come for GDX. I believe it's about 1440, so it's right on that red line. And for GDXJ, I believe it's right around 20.5. So you can see why the 50-day moving average is major short-term resistance. I mean, that area for the miners. Now, what would be bullish for the miners, I think, is if they traded lower and again bounced from the lows at 13 and around 18 for GDXJ. So if they kind of put in a mini double bottom here over the next couple days, that would reestablish the support, and I think that would give the miners a chance to, possibly rally, have another tradable bounce, tradable rally. But not discounting that scenario, if we see the miners rally up here to the 50-day moving average over the next couple days, they would be a sell in my opinion. I'd look for that resistance to force them back down. That's all I got for today. If you haven't already, you can get my book for free. I'm going to be updating it in December. If you're already on my list, you'll get the update. Don't worry about that. Go to thedailygold.com/book. You can get the book for free there. And you can follow more of my work at thedailygold.com. Feel free to email me with any comments or questions. Thank you all for listening and watching, and I wish you the best, and we'll talk to you again in the next week or two.